Hey, Jeff Santoro, the voice of the people. How are you, buddy?
I'm good. How are you?
Good. I'm excited to be doing a video here with you. When we talk stocks, usually you and I, we're usually talking about stocks that we already own. And that's good, right? It's businesses we know really well. We have skin in the game, all of that kind of thing. But we also have stocks on our watch list, and we don't talk as much about those on video. Right now, we're going to talk about two stocks that we don't own either one of that are at the top of our watch lists to buy. Now, yours is one neither one of us have ever owned. It's a newer company. What I'm going to talk about, I used to own it. I don't anymore. I'm thinking about owning it again as a turnaround story. You ready to dig into this?
Let's do it. I want to hear about yours. I'm very curious.
I am Jason Hall. He's Jeff Santoro. This is Investing Unscripted. We have a great partnership with The Motley Fool, the sponsor of this video. Now, we've got two great stock ideas right here for you for free. All you got to do is watch us and you get these great stock ideas. The Motley Fool is going to give you its 10 best stocks to buy right now. Also for free, just go to our link. It's fool.com/unscripted. Again, fool.com/unscripted. It's going to be on the screen right there, the whole video. So when you get bored listening to me talk about my stock, you get bored with Jeff talking about his coffee company, go check that out. Some good ideas there for you for free. All right, Jeff, I buried the lead a little bit. Dutch Bros, let's talk about it.
So if you've never heard of Dutch Bros, ticker BROS, you could be forgiven because while it is a fast growing coffee chain, it is currently only in 17 states. So about 2/3 of the country doesn't live anywhere near a Dutch Bros. And
I think another reason that people might have not followed it is because of this, Jeff, right? The stock is still way down from when it went public. And that's a turnoff for a lot of investors. It's been a loser so far.
it is like two ways you find out about a company like this is you know the business because you've been to it or you're near one, or if you're an investor, it's done well and then therefore it bubbles up in the world of stock picking. So this one's a little bit under the radar, I think, in both of those ways, both to consumers and to investors, especially those who don't live in a state where they operate. But they're growing quickly and they have some things going for them that I think make them pretty compelling. So I'm going to screen share here from their investor presentation. The chart on the top left is where I want to start, which is with their shop growth. So you can see over the past year, Q1 to Q1, they grew their total shops by 22%. It's important to note here, too, that the company-owned shop openings, which are the darker blue in the two columns there, that's on purpose. They are not ending their franchise locations, but they expect that the vast majority, if not all of their future growth will come from company operated shops. So that's something just worth knowing. What I think is interesting is this piece. So as you can imagine, if they're opening a lot of stores each year at new shops, they're spending a ton on capital expenditures, right? Because it takes a lot of cash to open new locations. And that's absolutely the case. They are operating cash flow positive pretty consistently, but CapEx spend is keeping them free cash flow negative, right? So that's how their cash profile shakes out.
Those are pretty solid gross profit numbers for a restaurant style business. And the fact that they're growing points to them getting better and better leverage as a buyer of goods and some pricing and some cost controls they have in place. That's the kind of trend you like to see.
Yeah, and this is why you might look at the cash flow statement and say to yourself, oh, this company burns cash and they're spending a lot on CapEx. But I do think, A, you have to do that if you're going to be in rapid growth mode. And B, these stores that come online get profitable and they start to contribute to the overall margin profile of the company pretty quickly. It says here in the first quarter that new shops are open, they operate at a gross profit loss, right? So the cost of goods sold is higher than the actual revenue they're bringing in. But within 3 more quarters, they're up at 25%, which is right in line with the company's overall gross margin profile. So even though they're spending a lot of money, these stores come online and they get up to speed in terms of contributing to the overall business pretty quickly. And I think that's something to keep an eye on. And then their same shop growth numbers are pretty spectacular overall. This past quarter was crazy. 10% is pretty nuts in terms of year over year same store growth. But if you look back just over the past 2 years, it fluctuates, but it's pretty decent. So I think those are bullish things in my mind. And the store growth thing is interesting too, because they're targeting 4,000 locations in the future. They don't give a timeline for that, but that's where their ballpark is. And right now they're significantly under that. But what's interesting to me is, just to put it in perspective, there are 40,000 Starbucks locations.
Well, you mentioned Starbucks. I think that's a good segue here. Starbucks in the same calendar quarter, like their fiscal quarter is different, but the same calendar period, they had negative comps. The traffic was slower. And so I think that's a big positive to point that they're still growing quickly, increasing. So comps, again, that's sales in locations have been open for at least a year. So it doesn't include the new ones. That could stabilize ones that have been around. That, to me, that's a really bullish statistic. I want to share one more thing too, I think, to really put context on the first chart that I shared, because this is a little bit that I've noticed about the company. Again, we talked about the stock makes it look like a loser. Just looking at pure revenue from when the company IPO'd in late 2021, revenue was $400 million a year was the run rate, and now it's over $1 billion a year. So the growth is incredibly rapid at this.
Yeah, revenue growth has been really impressive, and they're not far from consistent GAAP profitability either. Like, it's a little bit choppy at this point. It looks like they're treading water on the bottom line, which is still, with that rapid growth, with the store openings, with the cash burn to open the stores, but with the stores that they do bring online contributing pretty quickly, feels to me like they can sustain this growth, and they're not growing faster than they can handle, which I think are good signs. Will they ever get to 40,000 locations like Starbucks? I don't know, but I don't think they need to. I just think it's an interesting growth story, something to look at. I like the profile of how they're growing, and that's why it's on my watch list.
Let's talk about Intel here. The long-term story of Intel is a massive winner. This is the company that was the hardware partner in the Wintel duopoly of the modern PC era. But the company has ceded a massive amount of that market to smartphones. These things have taken massive amount of share from the way people compute today, the way people do so many things. And of course, we've seen the advent of artificial intelligence with GPUs, something that Intel never prioritized, now taking more and more share from the data center market. I'm going to share a chart here. This is a 5-year look. Stock price has not done well. This is total returns. This includes dividends paid. Now, they slashed the dividend recently, which honestly is a bullish move to free up capital to turn the business around, but massive opportunity cost too, compared to what the market has done, the broader market at the same time. And unlike Dutch Bros, with that great revenue growth, guess what? Revenue decline essentially has matched the stock price decline. So what has happened? Intel was so focused on, I want to say it's a little bit of kind of the GE Boeing approach of really focusing on economic returns and margins, and maybe not spending as much time and money focusing on being innovative, spending enough money on R&D, staying ahead of its competitors. And they've lost major markets. We talked about mobile computing. We've talked about the advent of artificial intelligence, autonomous driving, so many other things that Intel has missed the boat on. Now we have Pat Gelsinger that's come in to try to turn the boat around. I want to talk about why I think now might be an interesting opportunity. Jeff?
Yeah, just as a consumer of consumer electronics, I've noticed as an Apple computer user that they no longer use Intel chips in their devices, and they've switched to their own in-house chips. And so just from a user standpoint, I have noticed that they've seeded that market, at least. I know that's not the majority of the PC market, but I'd imagine there are other competitors working on the same thing on the PC side of the house.
Yeah, they've lost a lot of, in just desktop computing, they've lost ground to AMD. And they've lost ground to AMD in the data center as well for their microprocessors and for GPUs, both. Company had lost so much ground, had ceded so much technical advantage to the competition. But now I feel like it might be time to maybe dip my toes back in. I'm going to share a couple of slides here from a recent presentation that Intel gave. This was from back in March, but it's talking about really how artificial intelligence is playing into some of the opportunity and specific segments where Intel already operates and thinks they can operate more by 2027, turning into a $110 billion market and growing at an incredibly fast rate. And of course, their x86 architecture, what's going to be interesting to me to find out is if they can leverage their x86 architecture against some really superior power profile competitors that have certainly been beneficial in terms of smartphones. And we're seeing it become more and more of an issue in the data center, where massive amount of compute is being thrown at large language models and other artificial intelligence. So it's really interesting to see if x86 they're going to be able to leverage it in the way that we've seen competitors use things like ARM. This is the last thing I want to share. Again, CPUs and connectivity, this is where they've typically have lived, right? This has been their core business. These are areas where they've seeded market, that applications that used to be on CPUs, that used to be on Xeon in the data center, that have now moved to GPUs from AMD or mainly from NVIDIA. I'm going to plug our podcast a little bit here, Jeff. This week, we're recording a conversation with an expert in the semiconductor industry, and I'm going to be asking some specific questions about Intel that I want answered before I make the decision to move it off of my watch list and into my portfolio. These are my 3 questions. First question, is x86 salvageable in terms of an architecture that's going to be valuable for semiconductor companies to use Intel as a foundry, to come to them and build using their architecture. One of the things that Intel has highlighted is this idea of having one API to be able to design on across all of those different things, accelerators, GPUs, CPUs. And I want to learn more about that to find out if it's really, if x86 can be competitive versus what the AMDs, and if Intel can be competitive against the NVIDIAs and AMDs of the world across different kinds of applications. So that's a big thing. If they can do that, I think that's a big deal. I want to find out if structurally Intel is really strong enough at this point from a cash flows perspective to fund its ambitions. And the last question, will its competitors right now that want to design their own silicon and also potentially buy some Intel in-house designed semiconductors, if the company is at a point now where those two competing businesses can stand alone enough that customers could potentially trust Intel as a contract manufacturer. So I get the three answers to those questions. Then I'll decide if I'm going to move it from watch list to buy list. Last question for you. What do you need to see from Dutch Brothers to move it from your watch list to your portfolio?
I think I just need to see more of the same. I want them to keep growing their store count. I think this 25% a year amount seems to be the right amount in the sense that they can handle it from a cash flow perspective and from a profitability perspective. I think I want to see them do it a little bit longer and maybe see the price come down a little bit or the valuation come down a little bit. I still think it's pricey. Basically, it's just, can they continue to grow economies of scale and maybe even say sustainably profitable on the bottom line and still grow at that 25% as these stores more and more come online and contribute to the overall performance. Anything consumer goods is hard. It's so based on consumer preferences, and brand is a hard thing to build and develop, and they're going up against some big competitors. So I think it's just that's held me back.